Okay, the goal of this video is to show you all how to do Unit 3, Activity 5. The topic or the new concept in this assignment is the adding HST to our journal entries. So in previous assignments, we've learned how to do journal entries. And so this one is very similar to that, except for we're going to be adding HST, which is the harmonized sales tax, which combines both the provincial sales tax and then also the federal sales tax. And so that combination, I believe, is 8 and 5%, which makes up 13% HST. What I'm going to do is I will go through the first two transactions with you. And then I think I'm also going to skip down to the March 15th transaction just to explain that one a little bit because it's a little different than the others. And without explanation, it can be a little bit hard to understand what exactly is going on there. So we'll go through the first two transactions, as I said, and those should show you kind of the basic idea of how to deal with this and should give you two good examples on how to do the rest of them. So the first thing we want to do is we're going to take these in a several step process. I think it's like five or six steps. And that sounds complicated, but once you've had some practice doing it, it's not as complicated as it seems. All right, so the first thing we want to do is we'll look at our first transaction and we're going to determine which accounts are going to be affected by this transaction. So this very first one here, the March 1st, I've got it highlighted there. In this Excel template that we're looking at, you download this on D2L in the assignment section for Unit 3, Activity 5. So you can download it there and it should open up in Excel for you. And then it has all this so you can fill it in yourself. All right, so first transaction, March 1st. So the first thing we want to do is maybe the easiest part of all of this is just typing in the date for the journal entry. So whoever is going back through and reading this knows when this transaction occurred. All right, so that's the easy part, as I say, that's just reading. And then we get into the section where we have to start making some decisions or some judgments. So the first thing I would do is I would look at the accounts that are affected in this transaction, like I said. So we'll read it. Sold accounting services to Coffee Industries for $1,000 plus HST on account. All right. So the first one that jumps out to me is the Coffee Industries. That's the business that we sold our accounting services to. And then at the end there, it says on account, meaning they didn't pay us for our services immediately. They didn't give us cash for that. They said, we'll get back to you and we'll pay you in 15 days, 30 days, whatever the agreed upon time frame is. So our first account that's going to be affected by this transaction will be our accounts receivable for Coffee Industries. And if you're at a loss for what the possible different accounts are that are going to be affected in this assignment, you can look at this chart of accounts, which is off to the right by the transactions. And these are all the different accounts possible that are going to be affected. So if you look at those, it kind of gives you a place to start or a place to figure out what you might be writing here in your journal entry. All right, so we know that Coffee Industries, the accounts receivable for Coffee Industries is going to be affected by this. And so I wouldn't necessarily start off by writing that in the first line. I might wait to see what the other accounts are and whether they're going to be debits or credits before I start putting stuff in here. Just because, as we know, or as you might remember from the previous assignments, previous journaling assignments, You have to always enter the debit first in the transaction and then the credit or credits or debits, depending on how many of them there are. So it's not always the best thing to put it in first because you might have to rearrange them or reorder them. So what I might do is like off to the side, just put in the possible accounts for the moment, and then come back and put them in once I've determined whether they're going to be debits or credits. So our first one is going to be the accounts receivable of the coffee industries. And let's see, what's the next one going to be? This is where our new accounts that we're learning about in this unit or this activity come into play, those HST accounts. So for this example, since we're selling to coffee industries, we're rolling in the money that we have to collect for the government for taxes into the price that we're going to charge them. So our services that we're charging them is $1,000. And then above and beyond that, we also have to collect the HST money. And the HST rate is 13%. So the way that we calculate that, or we calculate what we're going to collect for HST, is just multiplying the amount of our services, or the amount that we're charging for our services, by that percentage rate. So in this case, it'll be 1,000 times 0.13. And then that'll give us how much we're charging for HST. And then once we collect that HST, we have to have a specific account in our business to keep it in. Because what you don't want to happen is you collect all of this HST or all of this tax money, and then you get confused as to whether it's actually your money that the business gets to keep, or if it's money that you then owe the government or have to pass on to the government. So the way that we deal with this is we have an HST payable account in our business to keep all the HST money that we collect. And then at the end of whatever the period is, at the end of the month or end of the year, we know how much it is that we owe the government that we collected through our business transactions throughout the year or the month or whatever the period is. All right. So in this example, since we sold our services and we charged them, our clients, a certain amount of money for HST, we got to put that money that we charge them into the HST payable account, meaning that's the HST money that we eventually will have to pass on to the government. So we'll just make a note here that we're going to be dealing with the HST payable account. And then the last account has to do with the amount of money that is actually going to stay in the business from this transaction. All right, so the amount of money that we get to keep for our services. And so that money is going to be accounted for in our revenues account, our revenue account. And the revenue account, as we learned in a couple of assignments before this one, I believe, is part of the income statement or the equity, owner's equity part of the balance sheet, right? And so that's the amount of money that's in the business that the owner could withdraw at any time for personal use and take out of the business without, harming the business or causing it to lose money that it needed or whatever to continue. So the revenue is the money that we get to keep out of this transaction, or the business gets to keep out of this transaction. All right, so we've got our 3 accounts that are going to be affected by this one transaction, that very first March 1st transaction. Now, what I would do is figure out the amounts associated with each of these accounts, or the amounts that we're going to be adding or subtracting to those accounts. And then after that, we'll figure out if that constitutes a debit or a credit. All right, so the first thing, so the accounts receivable coffee industries, we are charging them $1,000 plus HST. So in this scenario, that's $1,000 plus $130, which is that 13%. $130 is 13% of $1,000. So we're charging them $1,000 plus $130 in tax or harmonized sales tax. All right, so we'll put that in. $1,130 is what we're going to be charging them. The next question is, what are we going to be recording in our HST payable account? So in this case, all we're recording there is how much tax we're holding off to the side to eventually give to the government. So since we charged the coffee industries $1,130, $130 of that, the tax is going to go into our HST payable account. That's where we're going to record that. So it'll be $130 in our HST payable account. And then from there, the revenue is, again, the amount that we get to keep as a business, what we charge for our services. So that one is going to be $1,000 because that's what our services actually costed, and that's what we're actually planning on keeping for the business. All right. Good. So now we just have to figure out whether these are going to be debits or they're going to be credits. And the way we're going to do that is just think about our T accounts and kind of how we've determined that in the past in previous assignments. So for this one, the accounts receivable coffee industries, $1,130. So that one is a asset account because accounts receivable accounts are organized into the asset part of the balance sheet. That's money that we are counting on coming into our business, right? And so if we're going to be adding or increasing our accounts receivable, then that is going to be a debit, right? So we'll put next to it just a note, debit. Anytime we're adding to an asset, it's going to be a debit. For the next one, HST payable, that one is a liability because this is money that will eventually have to leave the business. We're paying it to the government. So that money that we collected as tax on this transaction will eventually be giving over to the government. So we can't really count on it to be part of our business for very long, right? So eventually we'll have to give that money up. So if that is a liability account, then the $130 will have to be credited to the HST payable account. Remember that when you're adding to a liability account or increasing a liability account, it's a credit. And then finally, revenue. I mentioned earlier that revenue is an owner's equity account or part of the income statement. So for that one, anytime that you're adding to your revenue, it's going to be a credit because it's over there on the right side of the balance sheet. All right. So it just so happens that in laying this out and figuring this out, I have these in the correct order. So really, I could have done it over here straight into the journal, but I wanted to kind of do my work over here first before I tried to put it in. So I didn't have to like move around my totals and confuse myself. So now that we have all this information here, we can put it into the journal in the correct format. So our first one is going to be the accounts receivable coffee industry. So I'm just going to copy and paste that over here. And then we said that's going to be a debit. So we're going to put the amount that we're putting into that account in the debit column. So the $1,130. All right, so debits go first. We don't have any other debits for this transaction. So then we're going to put in our credits. So I will copy and paste my HST payable credit here. if it'll let me do that. Let's see. Yep. And then in the credit column, I will put in the amount that we're putting into the HST payable account, which is the $130. That's what we collected in tax. Good. And then the only other thing that we have to remember for our credits is that those need to be indented so that at a glance, it can be seen that that is meant to be a credit and it offsets it from the debits. So you can just go to the home. You could just click in front of it and hit the space bar 4 or 5 times. Or if you want to be more exact or more Excel savvy, you can use this little increase indent button and it'll move it over for you. And then the last one we want to put in is our revenue. So I'll just copy that, paste it, I'll indent it because it's also going to be a credit. And then we put in our $1,000 amount there. That's the amount that the business is ultimately going to keep from this transaction. All right, so that's the first transaction. It takes a while to explain it and to walk through it, but when you guys find that you do this yourself and you do it a couple of times, you'll find that you make those decisions and kind of figure it out a little bit faster than I just did. All right, so as I said, we'll do the second one together as well, and then I'll let you do the others by yourself and see how you do with that. So I'm going to get rid of my work over here, and I'll just do the second one, same process that we did on the other one. I'll do it, set it up over here, go through my thought processes, and then I'll put my final version over here in the actual table. All right, so again, our first step, determine the date. And since we already have March up here, we can just put in the day. So it's March 5th, so a 5 works there. And then we got to read what the transaction is. So purchased equipment from BM Electronics on account for $2,000 plus HST. Okay, so this one is a bit different than the first transaction. And it's different because instead of selling something to another company, we're buying something from another company. So this one is sort of an opposite scenario. And so because of that, what we have to do for it is a tad bit different as well. All right, so again, let's walk through and see which accounts we think are going to be affected. The first one might be the BM Electronics. We bought something from them. We brought some equipment from them on account, meaning we'll pay you later. We're not giving them the cash immediately. We have decided to buy this on credit. Right. So to me, that means that the first account that I see that's going to be affected by this transaction is our accounts payable to BM Electronics. So I'm going to put that over here. And I'm not going to worry about what's first, second, or third right now. I'm just trying to figure out which accounts I think are going to be affected. And later on, we can do the formatting and making sure it's all in the right order and all that stuff. So accounts payable, BM Electronics, and I probably should have a hyphen there. All right. Next, we've got equipment, right? And so equipment usually has its own account within your business. So we want to add the value of this new equipment to our equipment account under assets. And as you see over here, equipment is one of the things listed in our chart of accounts. So equipment is going to be our other one that's affected by this. All right, and then our last one is the one that is new. So we paid $2,000 for this electronic equipment from this company. But we didn't just pay $2,000. We also paid the HST. The business charged us just like we charge other businesses for tax. So they charged us $2,000 plus 13% of that $2,000 so that they could eventually pay the government and give them the tax. Now, what makes this different than when we collect HST is that when a business buys something from another company, businesses aren't required to pay HST. And so instead of just not paying it, that's not how it works. You have to pay it, and then you keep track of how much you've paid in HST to other businesses while you're acquiring stuff for your business. And then you can subtract that from the amount of HST or tax that you're eventually going to pay the government. So you kind of weigh one against the other. So let's say in your HST payable account, you have $1,000. And in your HST recoverable account, which is this new account that we're talking about, let's say you have $500. All right, so that HST recoverable account is actually going to offset the HST payable account. So when it comes time to pay the government, you're not going to send them the full $1,000 that's in your HST payable account. You're only going to send them 500 because they owe you 500. The government owes you 500. You shouldn't have had to pay that $500 to other businesses for the HST tax. So that sounds kind of complicated, but I think once you go through it a couple of times, you start to understand what that means or how that works. So anyway, all that's being said, our third account for this transaction is going to be our HST recoverable account. As I said, that's a new account that you guys probably haven't heard of prior to this lesson. So HST recoverable account. And I misspelled equipment. I guess Excel doesn't give you a little squiggly line telling you misspelled it. So you gotta have a good eagle eye. All right, so we got our three accounts. And then just like we did last time, we have to determine the amounts that are going to be put in or taken out of those accounts, depending on what happened in this transaction. So for our first account, the accounts payable to BM Electronics, that one is going to increase by $2,000. We're adding $2,000 to the list of stuff that we owe other businesses or other people. All right, so we now owe BM Electronics $2,000. So we're going to add that to the list of our debts. So accounts payable is a liability, right? And so when we're adding things to liability accounts or increasing our liability accounts, that's recorded as a credit. And so we'll put credit here. I think I got ahead of myself, actually, which is easy to do when you're thinking about this stuff. So credit, and I said that we would start by thinking about the amount, so we will do that also. The amount that we paid BM Electronics was $2,000, but we didn't just pay them the $2,000, we also paid the HST. So the amount that we record here in the accounts payable to BM Electronics is $2,000 plus the additional $260 in tax. So our amount will be $2,260, which is $260 is 13% of 2,000. So we paid all of that to them. The next one, equipment. On this one, we have to figure out how much the equipment we bought is valued at, right? So that we can record that value in our equipment account. So we got $2,000 of equipment, worth of equipment from BM Electronics. It won't be this same number here, the 2,260, because we can't claim the tax amount as the value of the equipment, right? So the equipment is only worth $2,000, even though we paid $2,260. And then the last one is our HST recoverable account. And that one, as we just discussed, we paid $260 in tax. So we want to keep track of that in our HST recoverable account. So we know how much we can take off of our HST payable account later on when we're figuring out how much we need to pay the government in tax in taxes, excuse me. Okay, so we have our amounts, and then I jumped the gun and I talked about the credit thing here for the accounts payable BM Electronics. So just one more time, it's a credit because this is a liability account. And when you're adding or increasing liability accounts, it's a credit. For the equipment is an asset account. We own that as part of our business, so it increases the business's value to have that as part of our holdings or the things that we own. So we are adding to the equipment asset account. And so when you add to an asset account, that is a debit. And then finally, we look at our HST recoverable account, which again is a new one and one that we're learning about in this assignment. So this one is a tad bit tricky, and it's a little bit different than other things that we've seen before. So an HST recoverable account is called a contra liability account. And what that means is contra like this. So contra means like contrary or goes against or is like the exact opposite of what we normally think. So the HST recoverable account is recorded in the liability section of the balance sheet. And it's done that way so that it can be linked or put close to the HST payable account. Because what you ideally want to be able to do is at a glance, look at what your HST payable balance is, and then also look at what your HST recoverable balance is. Because as I said, the HST recoverable account is almost like a commentary on what's going on in the HST payable account. So the HST payable account at the end of the financial period, or when you owe the government, you might see in your HST payable account that you've got $1,000 that you owe the government. What you want to quickly be able to do is look at your HST recoverable account and see how much you have in there to offset that $1,000 that you owe the government. So, you know, if you have $250 in your HST recoverable account, that means that $1,000 that you owe the government, really, you only have to send a check for $250, right? Because you've already paid $250 in tax that you didn't have to buying things for your business, right? So that's why it's considered, or that's why it's put under the liability section. And so what it means to be a contra liability account is that you record the debits and credit in contra accounts contrary to the way that you normally would for that section of the balance sheet. So for example, the HST recoverable is under the liability account. So if you're adding $260 to it, you would normally go, well, okay, it's a liability and we're adding to that account. So it'll be a credit. But since it's a contra liability account, you'll do the exact opposite of that. And it'll actually be a debit. All right. And I guess the reason it's a debit and the reason that they have it like that is so that when you're doing your trial balance sheet, it'll show up across the ledger from the HST payable, and it'll offset the HST payable. So that's another one where it takes a little bit of practice to get it right or to remember. But, you know, it's kind of one of those things that you can just memorize. HST recoverable, contra liability account. It does the opposite of what a normal liability account does. And you don't really have to think too hard about it or rationalize it too much in your head. You just know that that's what it does. Or at least that's how I think about it. All right, so good. So now we have our three accounts. We got the amounts that we're going to be putting in those accounts or taking out of those accounts. And then we've also got whether or not they're a debit or a credit. Okay, and so In this instance, it was good that we did this off to the side rather than right in the journal, because as you see, the first account that we thought of and figured out was a credit account. So that one cannot appear first because it's a credit, and credits come after the debits in the journal. So what we want to do is skip down and put in our debits first, and then we'll come back around and put the credits in. So the first debit or first part of the transaction that we're going to put in is the equipment. So again, I'm just going to copy and paste it over. And the amount is 2,000, and that'll go in our debit side. And then our other debit is the HST recoverable. So we'll copy and paste that. And we'll put that in there. Also a debit, $260, as we said. And then finally, we will put in our credit. And so that's where we circle back around and we pick up the accounts payable BM electronics. And so we'll copy and paste that in. Make sure that we do our indent so we can see that it's a credit. And then we will put in the amount of $2,260. And for whatever reason, it's not populating the cents. So we'll do that. And it's not doing that. So let's see. I don't know. You guys probably, there's some Excel wizards out there that maybe in the comments or something, you can tell me how to get the cents there. Oh, you know what? Maybe I remember. I think somebody showed me this recently. There we go. This little button will add the 0.00 or take it off if you want, depending the decimals. All right. Good. So those are the first two transactions. Like I said, those are the ones that I'm going to go over with you now. Hopefully that'll help you do the rest of them. The only other thing that I wanted to do was this March 15th thing, just to show you how that works when you're sending your check to the government for the HST payable that you've collected over the period that's in question. So we'll do that one quickly, and then that'll be that. All right, so let's see, how many transactions were there? 1, 2 between. So I'd have to leave a little bit of space. Let's just call it there. That might not be exactly right, but anyway, you get the idea. You're going to have to do your transaction for March 6th and March 10th before you get down to this one. So anyway, I'm going to put it there. If that's not exactly right, that's all right. Make sure it's right on yours. All right, so this one is actually pretty straightforward. It just looks a little bit confusing, but the basic idea is this. Over the month of February, you have collected $1,500 in HST payable. So you've sold a bunch of stuff, and this is how much you've collected over the month. So this is what, according to your records, you owe the government in collected HST tax. But also you've bought some stuff over the past month. And so you've paid some HST to other businesses. And so that HST that you paid out, you don't owe to the government. So then you can subtract it from the amount that you owe to the government. And then this third amount is the amount that of the check that you're actually going to send to the government. So that number is just the original amount of the HST payable minus your HST recoverable. And then $850 is what you're actually going to write your check for and send to the government. So that's pretty simple. And actually in the journal here, excuse me, in the journal, you're going to be recording it in that order. So We can just put HST payable here. And it's going to be that amount that they have, 1,500. And so remember, HST payable is a liability account. So it's money that isn't yours and you'll eventually have to pay, in this case, to the government. And so you are, let's see, you are reducing that amount in the HST payable account. So you're getting rid of it. You're trying to get that $1,500 off the books. So you're decreasing that account. Since it's a liability account, when you decrease a liability account, that is a debit. So you're going to put your $1,500 amount there. All right, good. And so the next one is our HST recoverable. That's the next account that is affected by this transaction. And so the HST recoverable, as we said, is a contra liability account, meaning it does exactly the opposite when you're thinking about the debits and credits of a normal liability account. All right, so in this case, we are going to be using up some of that HST recoverable that we have been accounting for. We're going to use up $650 of it. So when we record that, we're going to be decreasing the HST recoverable account. And so unlike a normal liability account, it won't be a debit for the decrease, it'll be a credit. So we are crediting the HST recoverable account $650. All right, so we're using up that amount in order to pay for some of this $1,500 that we owe the government. Right. So that's $650 that we have already paid in tax, so we don't need to, send out again to the government, if you want to think about it that way. And since that's a credit, we got to make sure that we indent that. And then we've only got one more account that's affected by this. And this one is going to be our bank account. All right. So since we didn't have $1,500 in the HST recoverable account to cover this whole $1,500 amount in our HST payable account, we're going to have to write a check to the government for the difference between these two. And so the difference between them is $850. All right. So bank is going to be affected by this, and our bank account or our cash account is an asset account. And so when you are decreasing your asset account, that is a credit, right? So we're going to credit our bank account for $850. That's the amount that we're sending to the government. It's the amount that was not covered by our HST recoverable account. And since that's a credit, we got to make sure we indent it. Right. So that's how you do that one. All right. I hope that is helpful and that it helps you do the rest of the assignment. Obviously, if you do have questions, let me know. Or you can do it to the best of your ability, submit it, and I can make some notes on it and tell you what's good or what needs to be fixed or what mistakes you made and how we can go forward. All right, so good luck with it, and let me know if you need any help. Thanks, guys.